I want you to take a look at the money in your wallet. Or, the balance in your savings account. Just really picture it.
Okay.
Now, imagine a world where the government's only option is to systematically destroy the value of that money just to keep its own lights on.
It sounds like a conspiracy theory.
It does, but it's not. It's actually the mathematical conclusion from the latest news we're seeing. The United States is, well, it's trapped in what some are calling a debt doom loop.
And that's not even hyperbole. When you look at the raw data, it's almost an understatement. The very bedrock of the global financial system, U.S. Treasuries, has crashed by nearly 50% since 2020.
50%. That's a collapse you expect from, I don't know, a volatile tech stock, not the quote-unquote safest asset on Earth.
Exactly. And that's where we're starting this deep dive. Because the bottom line, based on all the analysis, is terrifyingly simple.
Which is what?
The U.S. government has borrowed so much, so fast, that the old math it doesn't work anymore. The market is betting on a crash, and the only realistic way out is to print trillions of dollars.
So our mission today is to unpack this. We need to explain why investors are fleeing, and most importantly, what this means for your wallet, for your mortgage, for the value of every dollar you earn.
It's the biggest economic story of the decade, and it feels like almost nobody is explaining the mechanics.
So let's get right into it. You said a 50% crash in long-term treasuries. Now, normally, when something drops that much, investors, they rush in, right? They buy the dip.
That's the rational playbook. Buy low, sell high. But what's so fascinating in the latest updates is we're seeing the complete opposite. Investors are not buying this dip.
They're not.
No. They're doubling down on betting against U.S. debt.
How do you even bet against the government? You mean shorting?
Exactly. We're looking at short interest. If you look at the ticker TLT, that's the big fund that tracks long-term treasury bonds, short interest has hit an all-time high.
So a record number of people are putting real money on the line, betting that the price of U.S. bonds is going to fall even further.
That's right. They're positioning for even deeper downside.
Okay, but why? I mean, if it's already down 50%, that seems like a crazy bet to make.
It is risky, but they're not looking at the price. They're looking at the why. And they see a supply glut that is just completely unprecedented.
A supply glut. Let's put a number on that. How much debt are we actually talking about here?
The number is hard to even visualize. Since the year 2020, the United States has issued over $15 trillion in new debt.
15 trillion in just, what, 4 or 5 years?
Correct. And to give you some context, that's an amount that historically would take decades for the U.S. to accumulate. We've crammed maybe 40 years of borrowing into a single presidential term.
But hold on, we've always had debt. The national debt clock has been a thing my entire life. Why is this 15 trillion so different?
That's the critical question. It's not just the amount, it's the quality of the debt. See, from the 70s all the way to around, say, 2010, our economy grew faster than our debt.
Right, so we were borrowing $1 to build a factory that made $2. Good debt.
Precisely. We were borrowing to invest and grow. But around 2012, that flipped. And since 2020, that relationship is completely shattered.
Shattered how?
It's inverted. We added that $15 trillion in debt, but the U.S. economy only grew by about $9 trillion.
Ouch. So for every $15 we borrow, we're only getting $9 of growth back.
We're losing money on the transaction. We are no longer borrowing to grow. We're borrowing just to keep the lights on.
It's like using one credit card to make the minimum payment on another one.
That's the perfect analogy. And that brings us right to the heart of this thing, the doom loop. It's a very specific mechanical trap.
Okay, walk us through it. How does this trap actually work?
Okay, so step one, the government spends way more than it collects in taxes. It runs a deficit.
Which is standard operating procedure at this point.
Unfortunately, yes.
Yeah.
So step two, to cover that gap, the Treasury issues more bonds. It floods the market with supply. But because there's just so much of it, there aren't enough buyers.
And when supply is more than demand, the price falls.
Right. And in the bond world, when the price falls, the interest rate goes up. That's step three.
Okay.
Now, step four is where it becomes a spiral. Because those yields are higher, the government's own cost of borrowing skyrockets.
So their credit card interest rate just jumped from 3% to 25%.
Exactly. And the scale of this is it's mind-blowing. The latest reports show the U.S. government is now spending over $1 trillion a year just on interest payments.
$1 trillion a year.
Think about that. That's about 20% of all federal revenue. 1 out of every $5 you pay in taxes doesn't build a road, doesn't pay a soldier, doesn't fund a school. It just vanishes to service old debt.
That is just dead money. Complete waste.
It's worse than waste because it creates a bigger hole in the budget. And because that $1 trillion is gone, the deficit gets bigger. So what do they have to do?
They have to borrow more money to fill that new hole.
Yes, they borrow more just to pay the interest on the old debt. That adds more supply, which pushes prices down again, which pushes yields up again, which makes the interest bill even bigger.
And round we go. The doom loop.
It's a self-reinforcing spiral. And the investors who are shorting the market, they see this. They know the math is broken.
Okay, so if this is just basic arithmetic, why hasn't the market already priced this all in? Why are people betting it gets even worse from here?
That is the truly scary part. There's a hidden risk factor that suggests the market is actually underestimating the danger. It's a concept called the term premium.
Term premium. Okay, I hear that phrase a lot. Explain it like I'm 5.
Think of it as a risk fee for time. If you lend me money for a week, the risk is low. But if you lend me money for 30 years...
Right. A lot can go wrong in 30 years. I'd need a much bigger reward for locking my money up that long.
That extra reward is the term premium. And historically, for long-term U.S. bonds, it's been between, say, 1% and 2%.
Okay, so where is it now?
According to the latest data, it's sitting at just 0.6%.
Wait, what? So investors are getting paid a historically low risk fee despite all this doom loop stuff we just talked about?
Yes, the market is acting like everything is fine. It's completely complacent.
Which it
Right.
very clearly is not.
Right. So the bet the shorts are making is that the market is going to wake up. And if that term premium just snaps back to a normal level, say 1.5%, bond yields will be forced way up.
And when yields go up,
Bond prices crash all over again. They're betting the real crash hasn't even happened yet.
they're betting that reality is about to hit the market in the face.
Exactly.
I want to pivot here because I can hear someone listening right now saying, okay, this is a Wall Street problem. Why does a guy in Ohio care about Treasury yields?
It matters because that Treasury yield is the benchmark for everything. It is the price of money for the entire economy.
So when that number goes up,
Everything goes up with it. Your mortgage rate is directly tied to the 10-year Treasury yield. So if this doom loop keeps spinning, your mortgage rate stays at 7, 8, maybe even 9%.
which freezes the housing market solid.
We're already seeing that. But it's also corporate borrowing. When it costs a company like Ford or Apple twice as much to borrow money, they stop investing. They don't build the new factory.
And eventually, they stop hiring.
Or they start firing. That's how a chart on a screen becomes a recession on Main Street. The government's debt problem becomes your job security problem.
That's the direct connection.
It is.
Yeah.
And that brings us to the end game. Because when a government is trapped like this, there are really only 3 ways out. 3 doors they can walk through.
Okay, let's go through them. Door number 1.
Door number 1 is the sensible one. Austerity. You cut spending. You stop the bleeding.
The responsible adult choice.
In theory. But to make a real dent, you can't just cut waste, fraud, and abuse. You have to cut the big stuff. Social Security, Medicare, or the military.
Which is political suicide.
It's impossible. No politician is going to get elected by promising to slash those benefits. So realistically, door number 1 is welded shut.
Okay. Door number 2, raise taxes.
Right. If you can't cut spending, earn more. But the problem is, big tax hikes tend to crush economic growth, which can actually make the deficit worse.
Then political.
The current political momentum, especially with the Trump administration's platform, is for cutting taxes, not raising them. The will just isn't there.
So door number 2 is also locked, which leaves door number 3. And I get the feeling this is the one we should all be watching.
Door number 3 is the one they almost always choose. It's often called financial repression, but let's just call it what it is, the money printer.
Quantitative easing.
Yeah.
The Federal Reserve steps in.
Yes. The Fed creates new money, literally out of thin air, and uses it to buy all those government bonds that nobody else wants.
How does that fix the loop?
Well, the Fed becomes the giant artificial buyer. Their demand pushes bond prices up.
And when the price goes up, the yield goes down.
Exactly. They manipulate the interest rate lower so the government can afford its interest payments. It's a way to monetize the debt.
And we've seen them do this before.
Many times. 2008, 2011, and of course massively in 2020. And here's the kicker from the latest news. The Fed has already signaled they're about to start again.
They have. I thought they were still talking tough on inflation.
They talk tough, but you have to watch what they do. They've already announced they will start buying short-term bills. It's a small step, but it's the beginning of the pivot. The consensus is that they will choose door number 3 because it's the path of least resistance.
It's the only one that doesn't require a painful vote in Congress.
Right. It
Yeah.
just happens. It saves the bond market and funds the government without any unpopular choices.
It sounds like a magic trick, but what's the catch? What's the cost of just printing the money?
The cost is that there's no free lunch. When you inject trillions of new dollars into the system to buy up debt, you are fundamentally diluting the value of all the other dollars in existence.
In other words, inflation.
Long-term structural inflation. The cost of saving the bond market is the permanent devaluation of your currency.
So they fix the government's balance sheet by effectively putting a hidden tax on your savings account.
That's the trade-off. It's a soft default. They will pay you back every penny. But those pennies will only buy you half of what they used to.
And that is the absolute critical takeaway for everyone listening. The system is being propped up by devaluing the money in your pocket.
Yes, your mortgage rate might come down eventually if they print enough, but the price of the house itself will be twice as high.
You're running on a treadmill just to stay in the same place.
That's the reality of the end game here. The math demands a resolution, and the only politically viable resolution is inflation.
We started this deep dive with a boring bond chart, and we ended up with a story about the future value of our own work and savings.
It really is, and I think the big question for you, the listener, isn't, will the government fix this? The math says they can't. Not in a way we'd like.
The real question is personal.
Exactly.
If the only solution is printing money, what do you do about it? If holding cash is a guaranteed losing strategy because of devaluation, where do you put your wealth to protect it?
Because holding cash is basically making a bet that they'll choose door number 1, austerity, which we just agreed is politically impossible.
You're betting against the incentives of every single person in power.
And that is the thought we're going to leave you with. The government has a plan to get out of this trap. Do you?
Watch what the Fed does next. It's all going to be right there in the open.
Thanks for diving deep with us. We'll see you next time.